the ultimate destination for smart investing. Welcome to Invest Ideas, where we turn your financial dreams into reality. Subscribe now and join us on the path to financial freedom. Hey there! Let's talk about something interesting today. I know we have all heard about the debasement of currency, the deterioration of credit quality, and how the United States has accumulated over $100 trillion in on and off balance sheet liabilities. But have you ever wondered why most people don't seem to care about this issue? Well, it's because most people are illiterate and don't understand what $100 trillion even means. It's crazy to think that there are negative real interest rates out there, yet most people who are getting a measly 3% return think they are doing well. But let's face it, as people learn and think more about this, their perceptions will slowly start to change. Unfortunately, people want certainty, and certainty is not always on offer. I was struck by a conversation with Lobo about what people want and how they crave certainty. But let's be real, certainty isn't always possible. Instead, there is a range of probabilities that we should be considering. From my perspective, the range of probabilities points to higher, and probably much higher, gold prices. Welcome to the world of zero-sum investing, where we provide news on the world's financial markets. Don't forget to smash the like button and subscribe to us for more updates. My outlook is very close to Lobo's, but let me give you a couple of disclaimers first. 1. I am not an economist. 2. I have a new bank and organization, and I'm in front of the Fed, so there's only so many anti-Fed things that I'm inclined to say. I'm just talking from my own book from my own self-defense. I must say, though, that I am impressed with the relative strength of the US economy in the face of a doubling of interest rates. My suspicion is that the impact of that increase in interest rate has lagged, and if we begin to see more disruption in the economy, I think that the Fed will do what they did in 1975, which is to say, turn tail. I agree with Lobo's choice of words when it comes to the nominal price of gold. If you measure gold and current, as opposed to constant dollars, we will cross through a nominal high, but it will have less purchasing power than it did the last high. However, my wild guess is that gold will cross its old high in real, as opposed to nominal, terms in the not-too-distant future, which is to say, within 5 years. Unlike Lobo, I look at real interest rates in terms of the strength of gold. The arithmetic around the US 10-year Treasury, where the Fed pays you 3.5% in a currency that's depreciating in value by 7% compounded, tells me that gold has to win a fight against what Jim Grant calls return-free risk. And I think gold can do that. I remember very well the decade of the 70s, when gold had a pretty good run from a price-controlled $35 to $200 in early 1975. Gold had lots of friends after a six-fold move. Then, the Fed tightened in 75, and gold fell from $200 to $100. The economy went into a tailspin from higher and higher interest rates, and the Fed lost its nerve. All the people who had been friends of gold after the run from $35 to $200, not all of them, but many, got shaken out at $100, and gold proceeded to go from $100 to $850. All of this says, as you suggest, that what is inevitable isn't necessarily imminent, and there are very few certainties. There are just probabilities. All I would ask the audience to do is to keep an open mind and educate themselves on the fundamentals of the economy and the financial markets. It's important to understand the risks and uncertainties involved in investing and to have a diversified portfolio to mitigate those risks. It's also crucial to remember that investing is a long-term game, and short-term fluctuations should not be a cause for panic. As Warren Buffett famously said, "Be fearful when others are greedy, and be greedy when others are fearful." In summary, the world of finance and investing can be complex and uncertain, but with education and a long-term perspective, one can navigate the markets and potentially reap rewards. Thank you for listening, and don't forget to do your due diligence before making any investment decisions. Thanks for tuning in to Invest Ideas, where we bring you the latest insights and strategies to help you make informed investment decisions. Don't forget to hit the subscribe button and stay ahead of the game. Until next time, happy investing.